Welcome to CEO Connect, presented by CU Solutions Group. On this month's episode, a direct response to recent attacks on the credit union tax exemption by the Independent Community Bankers Association.
Recently, the Independent Community Bankers Association, or ICBA, established a new task force to establish a game plan to somehow paint credit unions' acquisition of bank accounts as a disservice to taxpayers. In the ICBA template grassroots advocacy letter that they're sending to their bankers, it urges member banks to ask members of Congress and state lawmakers to re-examine the credit union industry's tax and regulatory subsidies. Of course, this is nothing new. Way back in June of 2004, Michelle Heller wrote an excellent opinion piece in the American Banker publication titled, "A Battle Banks Can't Win, But Keep Fighting," in which she called it the dirty little secret of bank lobbying. That is, that their credit union bashing is a waste of time, and fighting the credit union tax exemption is a battle that bankers know they can't win, but know they must fight. And so what is different this time? Well, ICBA is asking member banks to take the position that the small number of bank acquisitions by credit unions that's happening around the country is creating a hardship for taxpayers. In fact, the advocacy letter template that they provide to bankers references a minuscule $3.9 million of lost tax revenue from the 9 deals that took place in the last 12 months. Only 9. Keep in mind that according to S&P Global Market Intelligence, recent tax reform legislation that was passed by Congress padded community bank earnings by over $1.7 billion. That's billion with a B. Those were dollars actually taken away from the U.S. Treasury to increase banks' profits by over 5% each year. I hesitated to even address this latest misrepresentation by bankers' associations, but as credit unions consider growth strategies and the refreshed strategic plans at this time of year, I wanted to clarify some of the banker rhetoric. It will be important for individual credit unions and their associations to do the same as bankers initiate this very spirited letter-writing campaign with members of Congress and with state legislatures. And as credit unions do their planning, they should make legislative advocacy and public relations an important dimension of their plans. Safeguarding and enhancing credit union charters and powers is the foundation for growth and success in the credit union industry. So here are some important points of clarification for lawmakers on this latest ICBA rhetoric. First, credit unions are not actually acquiring banks. That is, they cannot legally own stock in banks and other corporations. They're not-for-profit cooperatives. These latest acquisitions are referred to technically as forward mergers for cash. But once the acquisition documents are inked and the ink is dry, the bank charter goes away and the surviving credit union owns the loans, deposits, account relationships, branches, and other assets. The depositors and borrowers now become members of a not-for-profit credit union, no longer customers of a for-profit bank. For decades, credit unions have been able to purchase and acquire bank loans, deposits, and branches. This is a good thing. It's good for the selling banks to have more options. It's good for the safety and soundness of the banking system, and it's a good option for credit unions and their members. These latest forward mergers for cash are just creative, cost-effective transactions for both the selling banks and for the customers who benefit downstream as credit union members. A second point. The number of acquisitions is incredibly small and not growing dramatically like bankers would suggest they are. Keep in mind that there were 5,600 credit unions at the end of 2018 and 4,600 banks in the U.S. So with over 10,000 banks and credit unions, the ICBA cites their knowledge of 9 credit union acquisitions of banks in the last year, up from 5 or 6 in prior years. This hardly represents what they call a runaway freight train referenced in their rhetoric by ICBA. A third point. In Michigan, since 2012, when United Federal Credit Union became the first credit union to use the forward merger for cash methodology for buying assets, deposits, and branches of Griffith Bank in Indiana, there have been 3 or 4 small bank mergers or acquisitions by credit unions each year until the recent increase to approximately 9 in the last 12 months, cited by ICBA. In Michigan alone, United Federal Credit Union, Advia Credit Union, Lake Michigan Credit Union, Michigan's largest, and Credit Union One are among the small group of credit unions completing these creative transactions. A fourth point, the ICBA is working against its own member banks by opposing these additional opportunities for small privately held banks to sell their business. For years, community banks and credit unions have been impacted by the negative effects of higher regulatory burden and competitive pressures coming from the larger scale banks in the U.S. primarily. The option for credit unions to participate in these transactions is good for those small banks looking to find a cost-effective exit from their struggling business, as opposed to relying solely on stock transactions with larger banks. A fifth point, the reason that credit unions are attractive buyers for these small banks is that they cannot do stock-for-stock deals. Credit unions pay cash for the merging accounts and assets as the bank charter goes away and customers become members of the surviving credit union. The selling banks like that option. This has tax advantages to the sellers and reduces the cost of the transaction. And owners of the selling bank realize that their customers will benefit from the great service, better rates, and lower fees offered by the acquiring credit union, more so than becoming just a number at a large competing bank. A sixth point, arguing against having a larger pool of acquiring financial institutions creates a potential systemic challenge for the banking system in the U.S. These bank association leaders are forgetting the effect of major recessions and financial crises in the U.S., such as the savings and loan crisis in the 80s and 90s, when over 1,000 of the then 3,200 SNLs failed, leading to new regulations, the merger of their deposit insurance fund, the FSLIC, with FDIC, and the creation of a new corporation called the Resolution Trust Corporation, or RTC. By the end of 1995, the RTC had closed 747 failed SNLs, resulting in a cost of $160 billion, including over $130 billion taken directly from taxpayers in the form of bailout funds. Remarkable. I remember those days in the early years of my career when I worked as an internal auditor for a large conserved SNL in Salt Lake City in the early 80s. I know how important it was then, and still today, that healthy financial institutions of all types be able to bid on the sale of assets and deposits of those who either want to sell or feel compelled to do so for competitive or for safety and soundness reasons. And more recently, the subprime mortgage crisis of 2007 through 2009 that led to the Great Recession that ended in June of 2009, that led to the Dodd-Frank Wall Street reform legislation. All of that led to scores of bank failures and a collapse of the shadow banking system of investment companies and mortgage companies. A whopping total of $626 billion was invested, loaned, or granted by the federal government to struggling banks due to various bailout measures at a huge initial cost to the federal government and ultimately to taxpayers. And often the only resolution for smaller banks was to find attractive merger partners. This is a critically important facet of the U.S. financial system. So it is incredibly inaccurate and disingenuous, frankly, for the ICBA to characterize the tiny $3.9 million of lost tax revenue due to a bank converting to a not-for-profit tax-exempt credit union, to characterize that as a, quote, runaway freight train. The societal benefits of allowing these transactions are far greater than the small dollars referenced by the ICBA. A seventh point, free market buying and selling of businesses, especially relatively small ones, in the case of these bank sales, should not be overregulated by Congress or state legislatures, certainly not for purely tax policy reasons. The free markets in the U.S. create an efficient market for buyers and sellers, and credit unions should be able to participate in that process on equal footing with their for-profit competitors. These transactions clearly benefit both the selling and buying institutions, and more importantly, the customers and members who enjoy the higher levels of service, greater value, and more responsible lending offered by credit unions, especially during the toughest of economic times. An eighth point, While bankers associations like ICBA try to paint the picture that smaller credit unions object to the growth and expansion of larger credit unions, they fail to realize that the credit union community is going through the same disruptive consolidation that is occurring in the banking sector. And often the larger credit unions and the larger banks benefit from that consolidation. But credit union leaders from institutions of all sizes largely realize that creative approaches will be needed for growth, scale, and competitive service offerings in the years ahead. Most, if not all, of these bank deals are being done by credit unions that have less than $5 billion in assets, and the selling banks have assets typically under $100 million in assets. These are small transactions relative to the mega mergers in the banking sector. They are likely the small deals that larger banks don't even want to bid on. The alternative is to restrict the pool of buyers and then risk creating losses to the FDIC or to taxpayers, as has happened both in the early 80s and again during the Great Recession in 2009, as I referenced. As credit unions seek to grow organically or through mergers, the consumer always benefits because these credit unions can offer the deposit rates, low loan rates, and a breadth of consumer and small business services that impact people's lives in a positive manner. More broadly, the over 110 million consumers who benefit from credit union services delivered by 5,600 credit unions of all sizes also benefit. This is because a strong, well-perceived credit union industry benefits all credit unions and their members. Brand perception is a powerful thing. And right now, credit union members love their credit union a lot more than bank customers like their bank. This most recent lobbying ploy by the ICBA to seek the taxation of credit unions and to drive subsequent conversions to bank charters is a continuation of bankers' frankly self-serving and anti-consumer attitude. But this time, in lobbying against merger options for their member banks, they also do a huge disservice to their own member banks, as I said. The American banker was right in 2004 in characterizing the dirty little secret of bank lobbying, that their credit union bashing is a waste of time and that fighting the credit union tax exemption is a battle that bankers know they can't win, but know they must fight. But it's also a battle they're fighting that isn't good for the consumer. For the bankers' associations, this is about their relevance to dues-paying banks as an association. It certainly cannot be about what is right for the consumer or for our nation's banking system. But an important corollary truth for credit union leaders is that fighting to preserve both the tax status and policies that enable growth, including the ability to acquire bank assets from selling banks, is a battle that credit unions must fight and win. Because in doing so, the selling banks, the acquiring credit unions, and most important, the consumers and small businesses served, all benefit from a vibrant and strong financial services industry. CU Solutions Group offers credit unions technology, marketing, performance, and advisory solutions to help them compete and grow. We partner with CUNA and state leagues to advance the well-being of the credit union industry so that together we can make an impact on the lives of the members we serve. We look forward to sharing this objective of setting the record straight with lawmakers so that good policies continue to benefit the members and communities served by credit unions.